friends. Good to see you again here for our third session on entrepreneurial finance. Please let us know in the chat if you can hear me and see me, and let us know if you joined the first and or second session. Now, for those who did not join any session yet, my name is Jerke Verschoor, and I'm the director of the Netherlands Education Support Office in Moscow. Today, our good friend and creator of this online course, Professor Dr. Hein Roelsema, will share his thoughts on how to secure finance for your startup, among other things. And afterwards, we're very honored to have Alexei Main, managing partner at Begin Capital and investor in 22 global startups in Russia, and he will give his view on the same. Now, without much further ado, I would like to introduce Professor Dr. Hein Roelsema, leading researcher in the field of entrepreneurship at HSE University. He chairs the Dutch Centers for Entrepreneurship, as well as the Global Entrepreneurship Network in the Netherlands and Europe. And in Russia, he further teaches entrepreneurship at Innopolis University. And he's also an associate professor for international entrepreneurship at Utrecht University in the Netherlands. Hein, welcome. I'll switch off.
Hi. You hear me well?
I can hear you well. Good to see you.
Good to see you.
I'll switch off my mic and my camera, and I will turn on your presentation.
So, yeah, thanks. So I have to wait a few moments, I guess, for people to see the presentation. So very happy to be here. Jerke already introduced me quite extensively, so let me just immediately jump into my presentation on how to fund a startup. So in this half hour, I would like to share a bit of a practical guidance on how to fund a startup. But as a disclaimer, please don't follow my advice. So like sheep, because I just simply hope that you get a bit of inspiration, but probably quite a few things will be a bit confrontational. So just make up your own mind. It's important to also understand that everything that I say should stay between us, because I don't want to be confronted with the things that I'm going to say here to you and share with you. It's just advice to you. So don't share this too much. It's bad for my reputation. So the second thing is the financial metrics for entrepreneurship are completely different than you would have in your accountancy course. So you should forget everything about Excel, especially everything about your banking course or the things that people know in banking. Completely useless. So the third thing that I would like to say is I'm not a bad person, although you may think I'm a bad person after this lecture. So I will not share these slides voluntarily. Probably Jerke has them. But I just want to say that I will share a bit of practical insight after many startups, lots of dragon dance and investing and things like that, which will be hopefully informative. Let me put it that way. Okay, so people can still hear me. Okay, yeah. So they can see. Okay, so let me start. The first inconvenient truth is that you have to lie and steal to fund a startup. So there is no way of hiding that you have to do this kind of things. So let me, of course, then the question is, of course, who are your victims? And with a bit of practical tips. So your first victims for stealing should be your parents, friends, and also your partner. Because these people love you. The trick is, and this is important for everything that I'll tell about victims, you have to do this all together, not just one thing, all together. It's the combination of it that makes the difference. So many of these people, they love you. So just don't approach one of them, your father or whatever, just approach all of them. You are a good beggar if you know the truth that if you get small money from everybody, that is actually a lot of money. So don't ask for loans or whatever, just small donations. And your parents and your partner and things like that, they might actually think that you have found something that gives a purpose to your life and that you like. So they are happy to support you. So don't really say things like that you think you're going to get rich, because that ruins your chances. You just frame it like you have found something that makes your life worthwhile. Important also tip is never tell your parents-in-law that you will become an entrepreneur. And for them, you stay a medical student or somebody who wants to become famous, because as soon as you talk people who have no interest in risk about you want to be an entrepreneur, they try to block you. So don't do that. The second source, the second victim, is that quite a few of you are already working. So you have to steal from your current employer. So how do you do that? Well, first of all, you have to get a job, a paid job that makes you able to work outside. So now in the Corona time, it's great because nobody is checking on us. So I get paid for sitting here and I can do all my startups of my employer paying. Just as an example here. But you have to work yourself in a situation where your boss doesn't see you, but still pays you, so that you can spend as much time in actually setting up your startup with somebody paying you a salary. So that's important. And also, if you work, you can put yourself into positions that you come across with very interesting people in your current job, and just be very detailed in getting your contacts. So use your current job if you have made up your mind, and make use of that. The third one, if you're a student, then you have to steal from universities and incubator. Look, all these incubators in university, they are only interested in showing how many startups they have in some kind of a reporting to local government or funder of the university board. They're not interested in what you're actually doing. So what you do, you don't register in one, you just register in 3. You get all the seed money. Nobody will check on that. And then you use that money for your startup. And very important lesson is that you go to incubators and to get money, to get feed, and to get a free office space. So don't listen to coaches from incubators, but pretend you're listening. So to get the money. So that's important for funding. Now the fourth one is you have to steal from yourself. So because you're talented, many of you are good students, so you can get a job that pays well. So you have to realize that if you become an entrepreneur, you'll be poor for 10 years. So you have to steal 10 years of income from yourself. So these are the 4 things that you can steal from to fund your startup. Now, there are 2 other sources. The first is there are lots of talk in entrepreneurs about your team, but you can actually steal very well from your team. So you should start with friends and pay them in stock options in your firm that have no preference. So they become useless if you sell out to a venture capital firm or something like that. So you don't have to pay them a salary. An important component of that is select people who already have a job and can do this on the side. So you don't get any kind of complaints that you have to pay people and that they get poor. So try to say, well, don't quit your job. Start to work in the weekend or in the evening for my startup, and I give you. So this is the way that you can get your first employees. And then the last one is often quite difficult, but you can look for suppliers and customers. So in suppliers, you can get, if you have a good plan, try to get some supplier credit and then just don't pay them. Or at least don't pay them in the first half year or so. And say, yeah, you'll get it. So then you don't have costs. But if you have customers, if you have already a few launching customers, try to get them pay you in advance for some prototyping, etc. Because that money you can use as working capital. Again, it's very important to realize that you have to do all these things together. So this is a bit like the sources where you can steal. Now, there are also dangers. And I'll tell you a few dangers that you come across if you start to fund your startup. So the first big danger is business angels. So you have to be aware that 99% of the business angels have no money. They are actually failed middle managers to do something in hip startups. So don't waste time on them. If you come across somebody who pretends to be a business angel, immediately ask, who did you fund before? Because that already kicks out 90% of them. The ones that do have a story and that do have a track record, you can start working with him. but don't give them a job. So many of the business angels actually try to sell themselves as a financial manager in your firm and etc., etc. Don't do that. So the second danger is that if you're a student, you go to public incubators and they ask for an equity share in your startup. Don't do that. Because if you give them an equity share, it's very difficult to attract future funding from venture capitalists, and even if you are interested in an angel. So they just have to be happy that you're there. So try to avoid that, including the Skolkovos of this world. So the third one, and otherwise go somewhere else. So the third one is banks. So if you have a startup, you have to avoid that you pay interest because you don't have cash flows. So if you make loans, you have to pay interest. So avoid that as long as possible. And if you need collateral for loans, try other people's collateral. But in general, banks want to work, but they give you a loan for which you have interest and you have no cash flow to actually pay for that. So try to avoid that. The fourth danger is network events. So if you want to be a startup, get serious and work hard. Network drinks are really for sissies. And they are for people from the chambers of commerce or for local government who want to look cool. So don't waste your time on all these network drinks in which you are invited as a startup to make. And you can go to network events where you're actually the only startup, and the rest is just would-bes. So what could be good is to have contests, where you can actually show and compete with other startups. So really, these contests, if it's a network drink, but it's actually a contest, you can maybe take the gamble, but don't stay too long in the parties. And because if you stay too long in the parties and the serious investors, they look at you, they say you're not serious. And so be aware of that. And don't be reactive. So never be happy with your current funding situation. Always look for new victims or new people you can extort. Because don't wait for new funding until you're running out of funds. So always try to bring in new money. So listen really to people like El Chapo who always are looking for new victims to do this. So that's important kind of thing to realize. So these are a bit of a very practical advice on how to start all these kind of things. So second inconvenient truth from my side. All good startups make losses for at least 10 years. A business plan that shows a profit anytime soon, if at all, is completely ridiculous. So any business plan I get that makes a profit, I already throw away. It's not interesting. So if we think about, I'm not saying that everybody has to be a Tesla or a Facebook or whatever, but everybody who thinks he can make a profit in 1 or 2 years or a business plan that shows that is not interesting. It's not ambitious enough. So be aware of that thing. What is important is that you have a bit of a clue in the business model how big and how long your losses will be. So why are you making losses? So if you talk about ambitious startups, basically you have a bit of a trajectory which is quite common where So why is that if you have revenue curves over time, which are the black ones, so you have some top somewhere far in time, then there are two other things that Art Groen already talked about. So you have the same kind of S-shaped curves for technology development and technology adoption, which are much earlier in time than your revenues. So you first have to develop technology, your platform or whatever it may be, your app, etc., which takes a lot of cost. Then you have to, and that is also important, but have it adopted. So if you want to have it adopted, you have to spend a lot of money to actually make people adopt it. It's the blue curve. And then finally, you can have revenues. But you also see on top the second movers. So you have to be, so to actually make money in the end, pretty difficult because as soon as you have the technology development, you have the technology adoption by some customers, then other firms will actually wake up. And before you can actually make revenue on that, they probably are moving in on you. So you have to keep on investing in improving product development. So until a long time from now, you might have a product which can actually make a profit margin in that sense. So that is a bit behind why people who make a profit in 2 or 3 years, they are not in the field of technology development. There's no reason for adopting. They actually start a Pizza Hut or something like that. So maybe that is not super interesting for people to fund. So it's also important to know a bit like to look at a bit of the stages. So we've talked about the development of the business model. So what you see is that if you have a long period of loss, then this is basically your net income. And this is what is called, so what I try to do, if you want to fund your startup, you have to know the terminology. So this is called, in entrepreneurial finance, the hockey stick. So it's a hockey stick because it has some kind of a stick form. And because it goes down, so your net income will go down. And then very late, if you become a scale up, then it starts to come up. And after a long time, it becomes actually positive. So there are certain things. So a lot of people focus on cash flows. So it's useful to know a bit about how cash flow normally would move on. So suppose you're funded in the beginning, and then you have to spend money on customer development. So you have to work with customers to see if you have really a value proposition. And then you see your cash flow going down. So you have negative cash flow, basically. So it goes down, 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 down because there are no revenues and you spend a lot of money in customer development. Then you have some kind of a minimum viable product that Martin was talking about. And you start selling this to, let's say, close people in the market. So you start to create a bit of cash flow. But given that you have also a lot of product development, it's still negative. Now, if you catch on, if you actually become a startup after some time, then you have to invest in capacity if your minimum viable product is working, and then bang, your cash flow deteriorates again. Then hopefully you bring in more normal customers, so not your friends or people who like your product anyway, and then you start moving to a stable cash flow. So everybody who's funding you, like a venture capitalist, would look at, is this actually moving in a predictable kind of way, as a kind of thing. So you'd have a long period of negative income, a long period of moving around cash flow, but ultimately, if you succeed, of course, if you create a company, then of course, ultimately, hope after some years, you have positive cash flow. But it's important to know a bit how the funding moves over time. So again, what I would like to stress is that it is super important to know what the key components of entrepreneurial finance and the words actually are. And there are two words that you really have to understand about entrepreneurial finance. One is called the lifetime value of your customer base. And the other one is the cost of customer acquisition. So entrepreneurial finance is to paint a picture about lifetime value of a customer and the cost of a customer acquisition. And let me tell you a bit what you should do for that, because so a lifetime value of a customer means is that you will have customers in the future, not now. So you cannot say this year or in the next year, we have so many customers, they pay this, because what matters in entrepreneurial finance is how much, if you have a customer, that customer will pay over the coming 10 to 20 years. So you have to bring forward the income. You don't have a customer yet. You don't have a pay customer. But you would say, well, if somebody takes it, and if that person stays a customer for 3 years, then I will earn that much on it. So you bring forward the lifetime value of your customer. Now you have to contrast this, is that with the cost of customer acquisition, which is if you know what you will earn on a typical customer, then the second question is, yes, I have all kinds of fixed costs which are not that relevant, which are easy to understand, but how much money does it actually take for me to get one customer in, which is the cost of customer acquisition? Now, so what you normally do with lifetime value is you look at what is called conversion rates. So if you have, let's say, a free version of a product and a paid version of a product, the conversion rate is how many people actually convert from free to premium. So, and how much does it cost for me in capacity, in emails, in people to actually convert them? So that's one example. The other one is, so you have to look at all kind of conversion rates. So if you go to Kickstarter and you put a product on it, how many people click on it, how many people click on Facebook and actually go to the page, all these metrics will show you a conversion rate and will give you some clue of how much it takes to land a customer and how much it takes to actually have this lifetime value. With respect to lifetime value, it's important to realize that what matters a lot is the retention rate. So you have to measure, if you have an app, how many people keep using the app and keep people. So for example, if 10% of the people drop out every month, then that means that on average, everybody drops out in a year. So then your lifetime value of the average customer is a year. So you want to you put your retention rate up, the retention rate up, so people don't drop out, and that creates much longer lifetime value of the customer. So you're not doing some kind of an Excel spreadsheet, but you collect all the conversion rates in your startup, and that is what you show to an investor. And you show, look, we have made sure that people in the coming years are more likely to move in this amount of people over that and that they stay in. So that is basically the things that are that are important. Another tip, if you make a business model for funding, you should, I say always never, or so I'm trying to make this as clear and black and white as possible. But you should not make a business plan or financial accounting for your firm if you are a startup. You should use unit costing, which means that you show the revenues per user and the cost per user, not in your firm, not accounting for your firm. So we would look at what is the margin you make on an individual customer. And on top of that, what you show is how much market share you would like to have. So you multiply that with your trajectory of how many people should come in. Why do you do that if you want to attract funding? Because for people who fund you, it's much easier to check your margins per customer based on the conversion rates. And it's much easier to check how many people you actually bring in on your network. So if they have the two, they have a clear idea where actually the startup is heading, which is much more interesting than having accounting figures. So these kind of things are matter. So just as a bit of sum up, what you should know is your customer lifetime value, which is the net present value of every converted customer. And it's very important how many people you keep in once they're in. The conversion rates are important. How many percent of the client content is converted into paying customers or users? Retention rate, how many people stay in, of the people who are in. The cost of customer acquisition, what is the cost to actually land a customer on top of the fixed cost? The burn rate is, okay, if you have this cost of customer acquisition, how much cash do you actually burn in the first month? The runway is then how much time, like an airplane, how much time do you actually have, given your burn rate, that your initial investment will last? So, and seventh is just try to always calculate back into the margins on the individual user base. Okay. So it's important that you understand, if you talk with financiers about what is lifetime value and these kind of things, there are also a few other things that I would like to stress. So it's important to get the words right. And this is my my concluding slide for my half hour. So it's important that you know how to frame these kind of things. So I've started off that you have to steal and lie. But you shouldn't say just hands up, give me the money. You use the word. So if you say that, okay, people get offended. But if you say, I'm bootstrapping my startup, which is basically politely saying hands up and give me the money, and then this is, let's say, a term. Not bootstrapping means, okay, he looks at every source that he can get his hands on. So it's an honest say, but it's not offensive. So don't say, I have no clue how to price my product or whether I will add real value, which probably is an honest answer because you have no clue if you start a fund. You're just saying, I'm improving my user experience. So I'm still looking for how people actually perceive this, which is basically saying the same thing. So don't get too explicit. Don't say, my startup will make losses for the foreseeable future, because that's probably clear to everybody already. And you just say, I'm growth hacking using network effects. So everybody knows that everybody who uses growth hacking means I'm not making any money. So don't say we have a recent history of massive fuck-ups. Even if saying those kind of things becomes more acceptable, you just say we have developed a strong narrative. So if you pitch these kind of ideas, then and fund these, also make sure that you mix in bootstrapping, growth hacking, etc., because these are the types of discussions that show that you're up to funding the startup. Good luck with that. I hope this opens up the floor to many debates. Jerke, where are you? I can see you, yeah. So I have to close myself down, I think, isn't it?
You can. Thank you very much. I saw people liked your presentation a lot. I saw already some discussion going on.
I guess so.
Yes, which is very good. And even our next speaker, Alexei Main, started commenting, which is very good on the use of Skolkovo and other useful or non-useful funding. Alexei, please switch on your video and your sound. And I have set up your presentation. We're very honored to have Alexei Main with us. As I told you, he's a managing partner at Begin Capital, worked in huge merger and acquisition deals, and is an investor in 22 Russian global startups. I see Alexei is now getting online. I will ask him to wait a little bit before speaking so everybody can hear him. I can see you, I think. You can start. So I will switch off my mic and my video, and I wish you good luck, Alexei.
Super, thank you.
Yes, I can hear you. Okay, good luck.
Super, thanks a lot. Dear friends, it's Moscow calling. Welcome to this online course. My name is Alex Mann, and today we are going to speak about fundraising. Let me start with a few words about me. During the last 15 years, I worked in various capital markets in private equity and venture capital industry. My total deal portfolio is around 45 deals with total value over $3.5 billion. Right now, I'm a founding partner at Begin Capital. Begin Capital is a VC fund with $30 million under management. We are investors in 22 tech startups and invest in 5-7 startups per year. Our companies are in UK, Berlin, Helsinki, Moscow, Silicon Valley, Madrid, and other locations. Also, I helped 13 startups to fundraise more than $100 million within the last 3 years. Now, a few words about the lecture. It will be divided into 3 parts. First, we will speak about why entrepreneurs fundraise, why the founders want to fundraise some investments. The second part would be the most important steps to successful fundraising the companies can do. And third would be the Q&A if you would be interested, if you are interested to ask any questions. So let me start with the idea of fundraising. Why do entrepreneurs fundraise? Of course, we know many examples where a great founder built his or her company just on his own, never attracted any investments, and the company is very successful, very strong, and profitable. But there are many industries where you definitely need at least some capital just to start. It's very difficult to open a restaurant or to construct a building or even build a tech company without a startup capital. So sometimes you need to fundraise just to have your first money, just to have some money to start your business. The second point of fundraising is, of course, speed. All of us can go from point A to point B just walking. But if you are in a very competitive world, it would be easier to fly from point A to point B. And fundraising can help you to fly on the plane, to build your company faster. And money can also be a very big competitive advantage, or the opportunity to hire best people. That's why we believe fundraising is important. Now, let's move on to the most important things in fundraising. The first one may be a little bit cruel, but it is really as it is. Ideas are worthless. Yes, maybe you have a great idea, but from the view of investors, we don't buy ideas. We buy the execution of these ideas. There are lots of examples like Google, Yandex, Baidu, who weren't the first engines in their countries. They come to a very competitive landscape, but their execution led to success. So don't pitch investors with ideas. Sell your execution of that idea. Yes, there are some industries like, for example, you can create a medicine for diabetes, medicine from cancer. But if you are not a great person to execute this company, investors will try to buy your formula, but not to invest in your company to believe that you can execute and build the company to be profitable and successful. So we come to the most important thing in fundraising. It is all about people. Yes, we invest into the founders. The question I always ask myself when investing in a company, would I buy stock in this person if I could? And this is the most important. People aren't everything. They're the only thing in the company. We try to evaluate a lot of points, whether we can believe in the founder or not. Is the founder able to attract the best people to work with him? Are the founders thought leaders in the industry? Please be sure, if I'm speaking to you about fundraising and about investing in your company, I will speak to most of the founders in this industry. I will speak to most of your competitors, and I want to be sure that I'm investing into the best team. Not the best idea, but in the best team. Step 3 is related to step 2, because it would be much easier to fundraise if you already have any sort of relationship with investor and you build this relationship before you fundraise. Because investors like to fund projects from founders with whom they are familiar. And it is important not to never burn your bridges, because you never know when a past relationship will come back to haunt you. And if you can, to reach your potential investors and cultivate the relationship before you actually ask for investment, it is also a very strong competitive advantage. You can always ask an investor about opinion or about some help or mentorship before you ask for investment, and it will help you to build a good relationship of trust. The most important step for me after the founders is tested and proven hypothesis. Let me give you an example. I am one of the investors in a restaurant chain in Russia called Soul on the Bowl. 3 years ago, a couple of founders come to me asking for $1.5 million to open 20 restaurants. My first question was, guys, were you in the restaurant industry before? No. They had a good traction and their reputation in different industries was very good, but they never were the owners of the restaurants or never worked in restaurants. So, but they were very good founders with a very good conception, with a very good concept. I gave them $5,000 and told them, guys, you owe me nothing, but let's test the hypothesis. So it's summer now, and there are lots of food festivals during summer. Can we please participate in 30 or 40 food festivals during summer and understand whether our concept is good? We started with the first 3, and they were far away from break-even. Then we hired a first chef, the second chef, the third chef, until we find the right person. Then we started to make a real-world A/B tests about pricing. We tested the price until we know the exact price which corresponds to the demand. By the end of summer, we were very profitable. There was a big queue of people waiting for our food, and our Instagram was quite popular. And people were asking, where can we eat in your restaurant? Where you eventually will open the first restaurant? Then I gave the founders another $3,000 and told them, guys, I know you want to build your first restaurant in Moscow City. I've made some negotiations and a big restaurant here ready to give you a sublease for 1 week to test your food and your concept. So we rent a small corner for a week. We understood that in Moscow City we will be quite profitable. Only then we decided to make a deal and open the first restaurant. After the opening, just in 3 months, we pay back all the investments, and we signed a deal to open 3 new restaurants. Now we are opening 5 more, and so on. That's why I'm speaking about hypothesis. You can test your hypothesis in every business before asking investment, even with a really small amount of money. And it would be much, much easier to persuade any investor to invest when you have a lot of validated and proven hypotheses. Yes, but hypotheses are important, but your story is also important. The best founders I know, all of them are able to pitch you or an investor or any counterparty about their business like a super interesting story. They run their business, their story. When you speak to them, it is super interesting. So the tested hypotheses are important, but the ability to make this hypothesis and your vision and your passion in an interest and make it all together a very interesting story of your life and the life of your business is a very essential skill. If you are able to do it and you are interested to investor, it increases your chances a lot. Another point is that you should concentrate on your reputation right now. We don't think a lot, we don't value a lot your wins in the competitions or the prizes you achieve or your PR in media. Forbes under 30 is a good rating, but it doesn't make you successful in the eyes of investor. Your reputation and what your colleagues think about you as a professional in the industry is much more essential. you need to be an industry expert in the eyes of investor. And also, don't be dishonest in any way. Don't be arrogant or unfriendly, and never burn your bridges. Also, the reputation is important, and never break an agreement, verbal or written, never in your life. It is really important and can work and decrease your chances to get investment. The next step is, of course, we are speaking how to attract money, how to fundraise. But I know lots of examples when a startup and investor signed a deal and they lived a little bit and understood that they have completely different DNA, and they suffered with lots of shareholder conflicts, and there were many examples of failure when startups decided to make a deal with the wrong investor. So it is important to sign a deal, but you should understand that you need to find the best match for you, who has the same DNA, who has the same philosophy. Because I do believe in a formula when 1 + 1 = 3. If you choose the right investor and understand that this investor is a good match for you, then your formula will be equals to 3. The next point is you can think of us as investors, as gamblers. Yes, we are gamblers. And we're really afraid to miss an excellent opportunity or to miss a competition for the great company. So if you are able to make different investors compete for you, this would be the best advantage to sign a good deal. You shouldn't lie in any way, but if you can make investors feel that this opportunity will be interesting to many others, they will compete for you and they will sign a deal as soon as possible. My last slide is to prepare you that fundraising is very brutal. The process of raising money is often long, complex, and ego deflating, especially in Russia, because when you are starting your fundraising campaign, 70% of your time will be fundraising. And it is great if you have a co-founder to spend time in operations while you fundraise. But it's never a sprint, it's a marathon. Yes, sometimes some people are like, you can't pitch investor with your attraction like, I was a co-founder of Skype and I sell, and this is my third company, and 2 first companies were sold at a valuation $1 billion. For you, it is a marathon. So be prepared to it. And the good deals usually needs a couple of months to close, to get closed. And in the end, I want to ask you about the hacks you've got and hacks you think which will increase your chances to fundraise. And if they're awesome, you can send them to alex.man@beginsale.com, and we will be happy to offer you a summer internship in our fund. So thank you for your time. Thank you for your attention. It is a big pleasure to make this lecture for you.
And I'm reminding people also, the lecture is recorded and you all have a closed link on YouTube. We pinned it to the top in our chat. Thank you, Alexei. Thank you, Hein. Hein, if you would like to come on back as well with your video and your audio. You both gave very practical and to-the-point presentations, which I'm looking now in the chat have been appreciated a lot. Funnily enough, and Hein, if you want to come back on, please do so. I see you coming. You both mentioned, of course, Skolkovo. And next Thursday, we have a lecture on entrepreneurial ecosystems with Arkady Vladimirovich Dvarkovich, the chairman of Skolkovo. So it'll be interesting to hear his point of view. But we had a question, and maybe I can pose it to you both, Hein and Alexei. Why are they time wasters? And why would you recommend not dealing with them?
Who?
Alexei, maybe you start? And then Hein.
Who are time wasters?
Incubators, like Skolkovo. Okay. Alexei, please.
Okay, I can start. Not think about all incubators as a time wasters. There are like 3 incubators in the world that really help you to fundraise. If you got an offer from Y Combinator, 500 startups, or TechCrunch, please take this offer and go there as soon as possible. But overall, we would like to invest in founders who do not need the knowledge and support from incubators, who are already rock stars and already professionals, who are able to attract best people in their teams, the best industry experts in their teams. As for the mentioned Russian incubators, the only problem is Russia, in the eyes of global society, is a bad hero right now. Henry Kissinger used to say, if you tell about someone that he is a rapist, pedophile, and he smokes, and then television shows that a person is smoking, everybody believes in everything else. Okay, Russia may be smoking, but we're definitely not as bad as the world is thinking about right now. But the state money from Russia right now is a little bit big risk if you want to build a big global company, because after you take some money from the incubators with the government money inside, lots of investors will not sign a deal with you because they are afraid of this money. And this money also corresponds with a very big shareholders' rights that these institutions wants to have. They're a very minor shareholders, but when you give a 5% minority shareholder the rights with a lot of vetoes to a company, you're giving them a keys from your flat, and it's a really, really big risk. But people who are working in Skolkovo and, for example, IIDF fund or any Russian state funds are great, but they're afraid to sign different papers. They want control because they deal with the state money. And this is a risk, and this is something very bad for you. You can't give the minority shareholders the keys from your company. Never.
Yeah, so I already see people saying that this is such an honest answer. So I think it is a very honest and very true answer. A few comments. I think that in contrast to so I think that maybe if you think about Skolkovo or things like that, your question, but if you think about Russian entrepreneurs as they are seen in the West, especially, there is a lot of interest. So it's not that it is that we see Russia or whatever. I think that we all know that in the Netherlands, of course, where we're from, we have Kaspersky, we have many firms who have Russian origin. We have many Russian students and many Russian entrepreneurs here. So I think this is quite general. So I just want to be, so you're referring to if you come from those institutions, is that very different in the Netherlands? Well, it's a bit different. So the minority, but on the other hand, I also mentioned that giving away equity shares to public institutions is also a problem here. And there is a choice, because many of the also public incubators, because everybody starts to know this, now start funding on revenues, or they only work with grants. So they become very well aware that if they do this, that they will actually kill their own startups. So it's also a bit of evolution that you're going through. I'm not saying in my presentation that it's a waste of time. I'm just saying that you have to steal from them. So if they offer money in grants, if they offer office space, if they offer these kind of things, you can take it. But just don't, as Alexei is saying, just don't sign the paper for minority stakeholders. But you can use them if they offer facilities. So that may not be a waste of time. It can create an opportunity.
Okay, thank you both. Another question. A lot of talk was about how to attract investors and why should they invest. There was a question if investors, they already know, or gamblers, as Alexei mentioned them, why would they decide to invest if they understand they will see losses for the foreseeable future? So what actually makes them tick for your idea?
Is that to Alexei?
Yeah, Alexei, maybe you want to start? Hein?
Yeah, let me. I can say, okay, so I think that so Alexei, of course, he can comment. They'll see that it will take a long time. So if you're a venture fund, then even in that process, you may not want to have an actual profit in that time because you have to sell off things or find a new investors. So everybody is aware. I think that the idea is important. What Alexei also said, and that I would really like to stress, he started with his presentation, is that if you move out the startup phase and you have done the kid stuff and you go to people like Alexei and venture funds, they buy into execution. They don't buy ideas. So the important thing is that you have to document your execution. So when I was talking about conversion rates, you have to document your successes in landing customers, having these campaigns, so that investors can judge your activity. So they might not be judging immediately how much money they can make. Of course, they have some idea, but they will judge based on execution, as he was saying, and that is what you can document right from the start as a startup, because that is the story that you have to tell to sell your company. And therefore, the more detailed you do that from the start, build your story, the better it is. And then you convince investors that they stick with you for a long time because you're executing.
Yeah. Alexei, would you like to comment?
Actually, I just have one comment. Of course, we know that we will write off lots of deals, probably. But the returns of venture capital are still quite high. If you identify good opportunities, if you invest in great founders, you can get a big, but risky, of course, return to your investors. So that's why there sometimes look like cruel people who stress a startup a lot, but we want the company to succeed. We really want to help them, to help great founders to build great and profitable companies.
Okay, thank you. And maybe next question, it turns up in these the pandemic times in every lecture. Maybe Hein, you can comment maybe from an academic point of view, and Alexei, maybe from your own experience as an investor in startup. Maybe Alexei, I start with you because the question is basically raised to you. How does your investment turn out now with the Corona crisis hitting, of course, the world, including Russia? You talked about Sol and the Bowl, the restaurant chain that you invested in. How are they dealing now in these circumstances, and what is your general advice in these times?
Actually, it's amazing to be a VC right now because you can find lots of amazing opportunities who suffer from fundraising and ready to sign bridges on the term of investors. Yeah, it's a little bit shame, but during March, April, and May, we closed 4 deals, and I've just raised the second fund, which will be based in Amsterdam and specialized on AI. And it was also quite an easygoing process because investors are ready to invest in to VC right now and invest into tech companies. Of course, some companies like restaurant chains suffer, but for us, it's not a big time of losses. We don't have a big staff, and nobody pays leases right now. So we have a very positive cash balance before the crisis. So after the pandemic, the restaurants eventually will be open someday. So based on our portfolio, most of the companies growing and growing even at a better schedule that we accepted before the pandemic.
Okay.
Yeah, maybe it's the same, but we are.
Maybe it's a story that I hear also more often from venture capital at the moment. I think it also relates to something you said earlier, in the sense that venture capital funds, if they have 10 investments, one have to succeed big time, and the other 9 might actually fail. But the one that succeeds has to fail. It has to succeed big time. So that kind of funding in startups does not rely that much on the day, in that sense. So that is one thing. What is much bigger problem is, of course, bank financing because they finance more normal companies and they rely on a normal return, and they pay interest that they cannot pay. So those companies, and let's say the traditional funders, are much more at risk at the moment because of the Corona crisis. The problem can be is that it can have a knock-on effect, because Alexei, he needs his funding from somewhere. So he will probably have the funding from equity funds, from banks as well. So if you cripple on that side of the banking sector, ultimately it might trickle down in problematic situations for venture funds as well, but not at the moment yet. So in general, if you have financial crisis and interest rates go up because of risk perception, that might hurt everybody. But this least probably in this sector, I would say.
Okay, thank you. Another question to both of you. Could you add, because we talk a lot about things that are going well also during the crisis, could you maybe share from your past one of your investments or your ideas that fell through, that really didn't work out for whatever reason it was, and maybe it was afterwards, with the knowledge that you had afterwards, a mistake. What was this mistake? How did it happen? And what did you learn from it? And I don't know, Hein, if you can comment on it as well. I don't know if you invest in startups successfully or not. But maybe to start with Alexei, could you share some of your thoughts?
Yeah, absolutely. Most of the faults are in the area either it is wrong people or wrong timing or small market. For example, there was a company who provides an opportunity to pay for parking with a mobile app. It started in Russia, in Moscow, then tried to go worldwide, and it also shows the free parking slots for people. The first problem was I invested there after they were in an incubator called IIDF, International Internet Initiatives Development Fund, and I faced the minority shareholder with a great veto power and lots of control, who wasn't able to decide fast enough, and you can easily wait for 2 weeks to decide on something if you are a Vodafone or Tesla or Apple. But if you are a startup, you need investors or the opportunity to decide super fast on a day-to-day basis. The second point was it was a bad timing, because we started to try to monetize the application in B2B, and we saw that for everybody. It's a great solution that it is possible to pay just in one app for parking, whether it is airport or a shopping mall or a business center, and it easily integrates with any vendor, and you just pay and please go free. But we haven't researched the market properly and tested the hypothesis. When we started to speak, for example, with airports, they told us the following: okay, we are Schiphol Airport in Amsterdam. Yes, this is a great idea. We want to use a mobile app to pay for parking. But first of all, we will build our own app to pay for parking. Guys, it is insane. Why do you think that people will download Schiphol, Sheremetyevo, or Heathrow app just to pay for parking? No, we want to be sure that it works, and we want to make it first at the beginning. And those dialogues were for 2 years. Right now, they're ready to discuss and ready to get access to any app to pay for parking. But at that point, the timing was wrong, and we didn't estimate that it is possible that B2B clients would decline our proposal because they want to build their application first. And it was insane for us. But after we went to the market, our first hypothesis didn't work. So we lost a sufficient amount of money for that time, and we needed to rebuild the company. Now it has completely different business, and it is profitable. But at that time, it was a complete failure.
Yeah. So I can add to this, but I'm more a serial entrepreneur myself than investor, although I did a bit. And basically, I'm a startup guy, and it all breaks down when it grows in that sense. Then you have to manage it. But as I'm a bit older, so I know that I have to step out after things succeed, and I start out. So that is. But I make my biggest mistakes in actually running companies, of which I'm not super good. So and therefore I would like to take up one question that I saw, which I think is a very important question. That was a bit on top on. So how do you avoid, if you pitch your ideas with investors, that they steal your idea? And I don't have, of course, the definitive answer to it, but especially if you have already a startup, you should be really sure what a key component of your business model is, and that you should not tell. So often in the operational element in business processes, how you do things, there is a secret on how you execute certain things. And so you can tell a lot about customers, customer segments, profit, lifetime value, etc. But your operational key element, where your value addition is, you should try to hide as much as possible. And so it's not easy. But for example, we had the example, you gave the example of Google. If you have Dropbox and technology, it was really how to get crossing the firewalls at that time and still manage the files to merge, which was the key component of that, and that they didn't tell. So you have to really know in your business model what is a key component that you don't share, or try to hide. And you hope that on average, investors are not smart enough, especially if you're in the technology field, to figure that out. And of course, they hire a lot of people, but that is one way. It's more difficult if you have let's say your business idea in the beginning, but you don't talk about really big investors then. But you have to be careful that you first work on it by stealing, as I told you, and know exactly where it is before you try to get investors who might actually want to steal these kind of ideas. But be really sure where your competitive advantage is, and don't try to share that too much. That would be my advice.
Alexei, would you like to comment on how
yes,
people could
add probably a few things. Okay, there are just a few funds or investors that who can potentially steal your idea. Yes, most of funds are really for them, their reputation in the eyes of the startup society is super essential. And we definitely do not want to execute your idea on our by our forces. But of course, if we speak to you, there is a very huge probability that we will speak with your competitors as well. And we will put our bet on the best company in the industry. But if you don't tell us your advantages over competitors, there is a huge possibility that your competitors will attract the money, and you will compete with a stronger competitor. So usually, and in absolutely most cases, investors don't steal your idea. Competitors can, but investors don't go to competitors and tell them that you should do like this. So the most important thing you should think about is how to be the best company in the industry, how to be the strongest company in the industry, how to attract the best people. And then nobody will even dare to think about stealing your idea. Everybody would like to buy your execution of this idea.
Thank you. And Alexei, you mentioned now in your answer that it's important to attract the right people. And we also, in all the sessions we had so far, and again here, it's very important to have the right people. So how do you go about this? How do you attract the right people, the best people? How do you test them? And also a question was there following, what would your advice be on working with very close friends in business? And in general, so it's about how to get the best people. And for you to start with, Alexei, and for both of you, Alexei and Hein, what are your personal criteria when you would invest in something or someone?
For me, is if the stocks will be traded, will I buy them or not? Yes, we want to invest in founders who will be able to be a CEO of the companies in 3, 5, 10 years from now, because the company is super different in various stages. The company on a pre-seed or seed stage is completely different from the company on Series A or Series B or growth rate or profitability. And sometimes it needs different people to manage it effectively. And for us, it is super essential to be sure that these people will be the same way effective or even more effective on different levels of the company growth. And we try to spend quite a lot of time before the deal with the founders, because when the founders come to us, we try to help them to fundraise with other investors, to introduce them to different clients, to test the hypothesis together. If we are successful in it, the startup feels we have a good match, and we are able to get a proper due diligence how the founder changes during 1 or 2 months working with us.
Yeah. So I think that people have to be aware that there's lots of what in economics we call statistical discrimination. So if I don't like you in first sight, I'm going to kick you out. So and move to the next one. And then so because there's only then a very small percentage that it will turn out okay. So with busy people, with investors, you have to make really sure that it's not just about the first impression, but that you don't talk too long to them in the beginning. Why not too long? Because you can only make mistakes. In the beginning, it should be clear you shouldn't make mistakes and have the right, so the slides should be working, the numbers should be correct, you should look them in the eyes and don't make any mistakes and keep it short. And that is very important. If you get that first part right, that is because otherwise it's unfair in the sense that people would say, well, I'm not going to invest in that. After that, they become a bit more lenient, I would say. So it's very important to get the first impression right, and especially if you pitch ideas, especially also in the finances, that you check it, that you don't make mistakes. Yeah, so that is, I think, my advice also for these first impressions and people. So how to judge? So what Alexis said, of course, you judge on certain characteristics, but we also be aware that people will judge you in the first 10 seconds. And after that, you don't get a second chance.
Thank you very much. I have a last question. It actually is a bridge to our fourth session on Thursday, because you both have been talking about Skolkovo and other incubators. And this is the area where policy actually assists entrepreneurs, but you both also warned for this. So why should people actually listen to the next session on Thursday? What can they learn from it, and what are the positive sides of such incubators?
Yeah, they will definitely learn as much from them as they have learned from us. So that is clear. They should still listen, of course, to them. But the answer is that if you're a young firm, you need help, and maybe not advice, but they will talk about, let's say, your total environment. We should not narrow this discussion to Skolkovo or incubators or whatever. You should see this also as these are parts of, but it can also be companies, scale-ups around you who have experience in this field to which you are complementary and do something new. So they will probably talk about the fact that you should surround yourself in an environment where you can use all kinds of things, and that you can have, that can be really helpful. So here, of course, we talk about going to venture or whatever, but and there is this startup stage where you need a lot of support. And Eric will also talk about that. How do you make use of your environment, of which Skolkovo can be one. But as we're bashing Skolkovo all the time here, it is also that it's simply broader than that, and you have to make use of that.
Alexei, would you like to comment on?
No, I think it is.
It is clear. Okay. Thank you very much, both of you. It was really an interesting discussion. There's people with more questions, but you have been so kind to share your email addresses with everybody. So I would suggest to everybody who has more questions, please spam them.
They're open. Yeah,
and they will very shortly, within 10 seconds after reading your email, decide if it's going to spam or going to OneDrive. I want to thank every one of you for joining in. Next week, as I said, this Thursday, as I said, Entrepreneurial Ecosystems with Professor Dr. Erik Stam, Professor at University of Utrecht, held positions in Cambridge, many other universities, really a leading scholar on entrepreneurial ecosystems. We also have Arkady Dvarkovich, well known to those who are Russian, and Vadim Galeev, working at Innopolis. So we'll actually discuss two of Russia's ecosystems. Alexei, it was a real pleasure having you with us. Thank you very much for sharing your very concise ideas. It was really good. And you got a lot of compliments actually in the chat. Same for you, Hein. Thank you very much. And again, Hein is one of the person who started this course. So thank you very much, Hein. To all those who attended, thank you very much. Hope to see you on Thursday. We will send you emails again where to find the presentations and the video links. Have a wonderful day. Talk to you on Thursday. Bye-bye, everyone. Bye-bye. Thank you all very much. Thank you for your comments. Hein, you're also still there. You're leaving now. I will close it down. See you all on Thursday. Thank you very much.